I just got a notification that we're live.
We're live. Welcome,
All
if
right.
anybody out there is watching us already. We're going to give a few minutes here to get everyone coordinated on. But maybe while we are, Michael, this might be a good idea. And sorry, I'm getting an echo. Here, let me mute the live stream because now I'm listening to what we just said 2 minutes ago or a second ago. Okay. All right, we're working out our tech issues here. Welcome to Community Capital Live. I am your producer slash host, Joel Skeen, host of the Mindful Marketplace on Biz Radio US. And I am very grateful that I get to be a part of this new series that we are doing all about local investing. And while we're waiting for our guests and our co hosts to join, I want to just introduce one of really the OG, the Godfather, the what do we want to call him? The source? No,
The
but
sort,
someone who
the
truly,
supplier.
yeah. Well, I always like you put yourself down as a neighborhood repairman once, and
Yes, it's
I
my
think that's fitting in a lot of
Instagram
ways.
handle.
Yeah, and but Michael Schumann is really grateful to have him as part of this project because if there's one person that you need to read their books and read their writings to get a grasp on how can we invest our money in
Hey,
our
can
own
you hear me?
communities and empower our own communities with our
Okay.
investment dollars rather than just sending that money to Wall Street and letting them do whatever they're going to do with it, is you should start with his books. I know I did. I read Local Dollars, Local Cents pretty soon after it came out, and then read his newest book, Put Your Money Where Your Life Is. And it's really amazing what is available out there that most people have no idea is available to them. And it's an exciting area because what's available to people keeps seeming like there seems to be, it's growing. There are more opportunities, but it's also kind of an area that most people don't know anything about. So the whole point of this show was for us to bring the local investment opportunities in any and all neighborhoods that exist in the U.S. to the broader public here. And so this is a partnership between Michael Schumann's The Main Street Journal, Kevin Doyle Jones's Neighborhood Economics, and my show, The Mindful Marketplace, to really bring that content together for everybody. And this is also being included with a database of funds, of investment funds across the country that you can locate on Impact Alpha and on the Main Street Journal. So, Kevin, I think we got you in. Thanks for joining us in here.
Thank you. Well, I'm on the farm and we can see broadband from here. Um, it's so anyway. I'm glad to be here, and I brought in Jim Warner at this week's fund, and I think it's pretty interesting because he didn't just start out to build a fund. When we started, when Jim Freudlich, who leads Impact Assets, and I started, he said, I just failed to solve malaria in Swaziland and Mozambique, and I was looking for something better to do that I could do. Turned out I was the wrong guy to solve malaria. And Tim said, "Let's do a fund. There is no growth capital for social enterprises. Everybody loves startup money. Nobody gives them growth capital." And we knew what we were looking for: 3 years operating, $1 million in revenue, a clear cost of doing good in the mission. We thought if you made market rate, you will. I'm trying to not cut off my head, Michael. Sorry. That was not an impact deal. An impact deal is there's a cost of doing good, and you can't solve structural systemic problems at market rate. So, and we didn't want to know model risk, no technology risk, no currency risk. U.S. domicile could work internationally. And we picked a fair trade because it already had a metric. We didn't have to, metrics have been a bog. And so we picked one that already had one. And also one where there was the mission enhanced the margin. And so it would have mission insurance. So because if you got rid of the mission, you would increase your cost of goods. People gave Better World Books their books. They sold them from libraries cleaning out their shelves. Queens Library made $200,000 a year or so. New York Manhattan Library sent us more books, but they sent a mess. And so we did that. And, Jim didn't do that fund that way at all. He didn't start out with the fund. Jim, what was the problem that presented itself to you that ended up with the fund? I've done many more things the way you did that than I did that fund. I've stumbled into them like a truffle hound and dug up something. Tell me your path to building the revolving fund, and say who you are. I'm sorry. Do your intro, etc.
Thanks. I'm Jim Weiner. I'm the president of Focus Community Strategies in Atlanta, Georgia. And we're a place-based community development organization in the model of CCDA organizations, or if you're familiar with purpose-built communities, we're a purpose-built communities network member. So been with the organization 16 years.
CCDA, for those who don't know, is a Christian Community Development Association. So it's looking at things from an asset base as opposed to a problem base. Peter Block and John McKnight were the kind of creators of, look at what they got.
Yep. And so if I were answering your question about the rotational capital fund,
yeah,
it would be a little bit of necessity being the mother of invention, right? We in 2008-9, you had the economy crashing with the housing bubble and the foreclosure crisis and banks failing, and we had a housing production model that really was 100% philanthropy. And of course, in that moment, it was extremely difficult to raise philanthropy. It was almost impossible as a nonprofit to borrow, and our housing production wasn't working. And so we gathered in 2009, we had stopped all housing construction, and we gathered a group of friends of FCS. All of them were in the world of real estate, and
go back a step. Why was it impossible for a nonprofit to get a loan? What was happening that was causing a change there?
Well, that was because of where the economy was, right?
Just
so
where the
everything got conservative, and if you were, I would say, in any way, a sort of a risky venture. Not that a nonprofit is necessarily risky, but in terms of we hadn't borrowed before. So it wasn't a time where you could just start borrowing. Our model didn't use lending, and so maybe it's wrong to say nonprofits in general, but certainly for those of
new
us
investments in a new way, yeah. And so you got this group together to say we're stuck.
Mm-hmm.
Who was in that room, and who'd you call, and why'd you call those people?
Yeah, so we had a couple board members, right? Almost everybody was a friend of FCS, so served us in technical volunteer standpoint. They all were sort of housing industry. So think a group that included an architect, a housing developer, single family housing developer, multifamily housing developer, a real estate attorney. So a group like that, and we set our current model where we raise 100% of the money to build a house using volunteers, and then we create a mortgage to put the family in the house, and we get that money back over 20 years on a mortgage. That was our model, and we had done hundreds of houses that way, but if you go back, we're 47 years old as an organization, so if you go back into the early to mid 80s, we could build a house for $40,000 to $50,000. So you raise $300,000 and you could do 5 or 6 houses in a year. And in 2008, we could do 1.5 houses.
Wow.
So we were running into the reality that the program was constrained in what we could produce. And so we put together this group and said, okay, we know when the economy comes back, like those who were acquiring property in 2009 and 10 were real estate groups that had liquid funding. They had cash
Right.
for buying up properties as inexpensively and as fast as they could. These were properties that had gone through foreclosure. And we were like, we would love to save some of those for affordable housing.
Right.
And so this group got together with us, and um, they helped us develop a fund that would be a combination of philanthropy and debt. And they actually, because we struggled to get debt from a bank, they actually put up the first debt. So we had 9 of them from that group. Actually, 6 were from that group, and 3 were networked with that group.
And what was the size of the debt?
The size of the debt was they invested $300,000. So we created $25,000 notes. They were all qualified investors. They each bought a 3-year, 36-month note that paid 4.5% interest annually.
Right.
And 3 of them bought 2 notes. So we had 6 that invested $25,000, 3 that invested $50,000 each, for a total of $300,000. And then we went to work on acquisition and construction.
And just a note, I'm finding 4.5% is an attractive number in a lot of these concessionary deals. You make money, but if it gets above 5%, the little calculator part of your brain starts thinking, well, if I got 6, damn, how can I squeeze 8? But if it's 4.5, it's like you feel it, you notice it, but it doesn't become that other kind of money.
Yes, agreed with you on that. And of course, at this point, if these were qualified investors, and so if they had the money in the bank,
Yeah.
they're earning less than 2%, and so 4.5% annually
Right.
was generous to us.
If you're somebody with a cash position, it works even better.
Exactly.
This is not to compare with CDFI things, but it's to compare with individuals who manage enough and realize a cash position as sophisticated money managers who know how to use their money. That's who this product is for.
Yes. And so we bought our first house and started working on it. And I met with, they had set up a smaller group of them sort of as an advisory council. And they were looking at the P&L on the first house and the balance sheet. And they said, "Where's your money?" And I was like, what are you talking about? We used the money that you gave us. And they were like, "Oh, no. We are not going to be 100% in the deal. So you have to have skin in the game." And this was, it'll sound silly, but a huge learning experience for us because we hadn't borrowed
Right.
a lot, but recognizing, oh, wait a second, like they were doing this in a very generous manner,
Right.
but they still are investors and they know
Right.
how to invest money and how to protect it. And so they said, you've got to have 40% of what goes into a house. And so I said, okay, we haven't raised that 40% that would go into this house.
Wow.
What do you want us to do? And they said, you stop production. And so we stopped. We went out and raised the money as quickly as we could.
And how did you raise that money? Was it all philanthropy or?
Yeah. So what ended up happening, a series of conversations where I came back to them and I said, okay, we are learning as we do this because we started putting our own money in on the P&L for them. I'm like, okay, you guys bought the refrigerator. We paid for the disposal and microwave. You bought the light fixtures in this room. I was like, this is not good for either of us.
Right.
Can we put our money in the pool?
Right.
So it's all coming out of the fund, and we're not pulling from 2 separate funds and accounting for, which we
Right.
could do, but it would have been crazy to do at scale. And they said, okay. So what we did is we agreed on our position would be 35% of the fund. So we went out and ended up in total raising 100. We had a foundation that gave us $180,000. We put that in the fund. The agreement then with the
And that
investors,
was your 35% was
yeah,
180,000.
so a total
Okay.
fund of 480. So
Okay.
300
Got it.
plus 180. And basically, they were learning as they were doing this for us, but they're like, okay, here's the guideline. Cannot work on more than 4 houses at a time.
Right.
You can't go buy 10 houses because it's inexpensive and then not have money to rehab them or build. So limited to 4 houses at a time. In the first 3 years, we did 12 houses. We came back to them at 2.5 years and said we would like to keep going. All 9 of them re-upped for another 3 years. And we kept going. We did 10 houses in the next 3 years. So we had done 22 houses. And at this point, our ability to handle the accounting, to pay debt service, to be able to give you, we had software construction systems, so we can show you exactly how much money went into every piece of the housing. I mean, we just matured as an organization, which, if we're going to talk about, we need funds that are patient, affordable, and generous. Like, we want our investors to be able to earn, but we also want them to let our homeowners who we're selling to be the beneficiary of their generosity. So that
Right.
balance, um, like, we just learned so much in this sort of period. And so
And
as
so
we,
with this partnership, your metric for success is the homeowner. And what are the things you look at for the homeowner? What are you designing for?
okay, so for this group, so as an organization, we have 4 types of housing we'll work on. We have a rental fleet, a single family rental fleet of housing. And that's all 80% area median income. So the families that are in that are at roughly 80%, which in Atlanta right now, that's about an $80,000 income for a family.
Right. So that's workforce housing. You've got 100 workforce housing.
Yep.
We're increasingly focusing on that. It's such a problem here. Our $1 billion tourism industry, you can't have any restaurant open more than 4 days because of the housing problem.
Yeah.
So anyway, okay.
So we have rental. We then do multifamily. So, like, we just finished last year a LIHTC, a low income
Yeah.
housing tax credit, LIHTC 84 unit LIHTC
Good,
bill.
boring. Okay, next.
Yep, exactly. And then on our single family home ownership, the for sale part, we serve 50 to 80% AMI, and on those houses, we become the bank and provide the mortgage. That is separate from this fund. This fund specifically served 80 to 120% AMI, families that could bank qualify for mortgages, but we're still needing affordable housing. So this is true workforce housing.
Hmm.
And that way, that's what creates the rotation, is when that bank provides the mortgage, the money rotates back into the fund to go into the next house.
Right. So
And
you're
so,
catalytic funding to get to a mortgage.
yeah. And so we actually have a CDFI internal to us that we provide mortgages through. So FCS will produce the house now. This is 15 years later. So as we've matured, we've also created now a CDFI. But uh, FCS will build the house. FCS Community Finance, for about 25% of the houses we build, provides the mortgage for the families in 50 to 80%
Yeah.
AMI.
And I know I'm getting into time when I'm supposed to open it up to folks, and I will. But I wonder how exportable is your model? You got some software. You know what works for workforce housing in 3 tiers within Atlanta. That's an exportable something. What's the deal to turn this into a template that people can copy?
So we have on our team consulting side, and we've got half a dozen neighborhood organizations like FCS that are now producing housing on our model, where we will help them articulate and clarify what type of housing they want to produce. We will help them build the pro forma, which tells them, one, how quickly they can go, how much capital they need to raise, what percent of that is.
We're working with a coalition here that's done some homeless housing on tiny houses on churches that is looking to expand. I would love to get Amy Cantrell talking to you about how to scale her model. That's a sidelight. Okay, Michael and Joel, time to rein me in. I will not let you guys have this guy
Well, I got a couple of questions.
and have any questions. If
One is,
Yeah,
so
go ahead.
you've been operating, it sounds like, since 2009. Have you been able to steadily grow your overall asset base, which expands your degrees
Good
of
question.
freedom?
Yeah, one, that is a good question. And also, just in greeting, Michael, nice to meet you. Joel, nice to meet you as well. Thanks for having me on.
Sorry, guys, I just
Oh,
took over
pleasure.
because
Yeah.
this is so damn interesting.
And with that, in answer to your question, yes. So the rotational capital fund case study sort of shows this, but we did 2 iterations with our initial investors. Then we went to philanthropy. We were able to add philanthropy, $500,000 of philanthropy on top of that. We grew it to about $1 million. Since then, we've added social capital investing. So we've got 2 or 3 different loans, $500,000. Think we've got, let me take that back. We've got 2 $500,000 investors that are social capital funds invested at 2% or 2.5%. To me, that's almost as good as philanthropy.
Right.
It just
Is this philanthropic dollars coming in, a DAF platform kind of thing?
One of them is a DAF platform. The other one is just a social capital fund that is part of the investment authority in our city. And they invested with us. And then we have a line of credit, another $500,000 line of credit from a commercial bank. That money's at 4.5%. It's the most expensive money now in our fund. And we pulled down that line last, meaning, we just have learned how to manage funds, which I would say for organizations wanting to do this, it's a super important part of the process is right size it in the beginning so you can scale to now we have $2.6 million in the fund. We build 12 to 18 houses a year.
Is there any gathering where people with your skill and nuance and multiple success nuance vectors around workforce housing meet and compare notes and figure out what the capital stack looks like?
Well, I'm hoping, Kevin, it can be your gathering.
Well, that looks like a really interesting thing. I mean, we did it for corridors and we did it for the purpose built, but this is just really interesting. I've got there are 2 players that are doing workforce housing as rentals of single families on church land. One is a fund I invested in out in California, and the other is a guy, Mark Boyce from here, who's has the biggest. Hey, Joel, I'm glad you made it back. Single family home building business, and he wants to do it at scale. And so the church becomes more public property. It becomes civic space, preserves the worship space, but they also get annuity-like revenue as the landlord.
Exactly.
But solving housing seems easier with rental than ownership. And so
I would say certainly the multifamily stuff. I would say for the 4 of us and our tribe that we represent, I don't know everybody's background, but technically for the tribe we represent, I will say somebody has to be thinking about home ownership as a wealth creation tool,
right,
specifically for our Black and Brown neighbors. We work in a Black and Brown community. I'm super passionate about, there is a whole national narrative that somehow we have to get over and think about But and we will fight that battle, like we will be in that narrative. But until
Right.
that is done,
Right.
we have right now over 100 families that we've created mortgages for in
Right.
our neighborhood that are starting wealth creation. So I'll stop there, but
That's a really good point. I
somebody's got.
completely agree with you, and that brought up something I hadn't thought of. I was just thinking about teachers and cops, sort of
I'm
thing.
with you for that.
Yeah.
So yes to that.
Right. Okay. Joel, you want to come back in and about take us out, or are you? Joel has been reconnecting again and again. Michael, do you want to jump in while we're waiting on
All
Joel?
right. Yeah, Joel, your sound is invisible to us, but I've got a few more questions.
Great.
So, as you have gotten, better skilled at doing all of this and better able to guarantee to investors, hey, you are going to get a reasonable rate of return off of this, have you started to think about maybe bringing in grassroots investors, unaccredited investors with notes more in the range of, I don't know, $500, $1,000?
Yeah, so we are in conversations about that. I would say we haven't done it yet. So we have a property that we're developing right now that I was hoping could be part of a CIT, a community investment trust, which would do that exactly what you're talking about, so that members of the neighborhood could invest and profit from a development. And I would say, I think that's in our future. We haven't gotten there yet.
Right.
Um, I think
Yeah,
the way to do that is, so I just sort of generally call these um, uh, equity share models, right? Like,
right,
and the community investment trust is one. We can also land trust some of our houses, um, is another way that we're sharing equity. Um, and we need more of those models. I would say FCS has not done that well yet.
Lanier Richardson does it with a really simple crowdfunding platform, and people, can invest at $100 and don't have to be part of a new governance structure. And he's done it. He's brought in about 450,000 on 2 community projects, and it changes
That's
things
awesome.
because the people walking down the block own the block.
Yes, 100%
Interesting.
agree.
Yeah. So, and that was another question I had for you is, so it sounds like you're thinking about bringing in a community land trust structure soon, but you decided in the beginning just to do the houses one-off rather than to put it into a community land trust. And I just want to know a little more of your thinking behind that.
Yeah, that's a really good question. And just for your listeners, in terms of a land trust, what we're talking about on that is you sell the house. It looks like traditional home ownership. So, like, you could drive by a house that's in a land trust and you'd have no idea. What happens though is we retain ownership of the land and we sell the house. So if you were just in an easy way to think about it, when you go to sell the house, if the land is a third of the price, you're dropping that price down. So let's say it's a $300,000
Right,
property. We kept the land, that $100,000 of equity or of land stays in FCS Community Finance. And then the house costs $200,000. So we've lowered the point of entry. And here's the give and take. The sort of give that reason we didn't start with it is because we don't want for families or individuals that are buying from FCS, especially if we're talking about a person of color. We don't, from an equity standpoint, it's not really fair that they own their house, but I own my land and house. Like there's an inequality there that we're not satisfied with. I will say this, as the housing market, we're in an urban context. City of Atlanta is expensive to live in, and as the prices of houses go up, it's not only low income neighbors that need assistance. We have middle class, sort of what we would consider working class folks that can no longer afford home ownership. And so at that point, this shared equity model of a land trust becomes more attractive. And the way we utilize it is it's not solving affordability in our neighborhood, but for the right family that views it as a stepping stone to full ownership, we would support that and we would land
Yeah.
trust property.
I mean, one of the things I've wondered about is whether you can create almost a step process. Like step one, you start with a community land trust. Step one is they buy the house. Step two is they buy the land, and you just continue to try to make the ownership more easy. I have
Oh,
another
I
question.
love that idea. I,
Okay.
I am a nerd for this stuff and think about it all the time. Have never had that thought. I just want to say thank you.
Oh, yeah.
That's awesome.
Well, let's
Wow.
let's let's make it happen. So, all right. Here's another question. 4.5% was a damn good rate to pay
It feels good
people
now.
in 2008, but with interest rates higher now, do you feel at all that you need to raise that rate to continue to induce, the higher end of investors that you have?
I would say we have not added investors in the last 18 months, 24 months. Um, and part of it is because we're watching interest rates rise. And at some point, because we're creating like we're doing mixed income affordable housing. And so this is a home ownership model. And at some point, uh, the interest rate in the fund limits our ability to create affordability on the ground in the house. And so I would say we have felt like, okay, we can keep producing. I will tell you, I have one of my investors in the fund. Our loan is coming up for renewal in 2025. I'm already talking to them. Yes, and I'm just I'm wondering, okay, are they going to come back and say, yeah, we'd love to stay in, but at this new rate? And so I do think it's a real conversation. And I forgot we did have one of the funds has two five and a half has $500,000 in at 2.5%, and they re-upped with us last year at the same rate, which
Right.
was super generous. But
Yeah.
it's a reality that I will say, if you had told me 13 years ago when we sat down with the what we at that time called this blue ribbon task force,
Mhm.
when that they would change my role at FCS. So as the president of our organization, I used to be, at the time we did that, I was the director of our housing, and our founder in 2013 stepped away. The FCS board asked me to step into his role. And so in this role, like I spend a good bit of time now courting and speaking with and writing narratives and pro formas to investors to do this. And I think as a nonprofit leader, like if we were having a discussion on finances, like having been around Kevin and his team just a little bit, I know enough to get me in trouble, but I am not a finance guy. I don't have a finance degree. I have a passion for affordable housing, but I would say it has changed my job. And so, for nonprofit, if there's other nonprofit leaders that are listening, I think a willingness to go to school and trust others around you that can help strengthen, like the question you just asked, Michael, of like it did, I'm just like, gosh, I can't believe that I haven't thought of that, and it hasn't been part of our conversation. But that's why we need a community having these conversations.
Yeah. Okay. So right now you have no place to go learn.
Correct. And I would say this, we used to do our learning at CCDA. So there's a whole group of CCDA, Christian Community Development Association practitioners, and they just had natural change as an organization and became more issue oriented. and housing is not part of what they do anymore. And so since that point, there's been a real gap of where we can go and learn and have these conversations.
That's deeply interesting. I'm glad this is being recorded. That's something we should think about, guys. The practitioners don't have a place to go learn, which also relates to that crazy long email I sent you in Sydney this morning. But anyway, that's another. There's no place to go and get smart. And there's a real place I see in innovative housing solutions and community focused commercial real estate where there's a ton of money wanting to go in and you can't do comparables, because your deal is a wonderful thing. There's no deal like your deal. You're a crazy one-off that is wonderful, but you're not like what Steve Want is doing, that is innovative housing, down with the Hello Just, and you're not like Devin Culbertson's land trust plays. You can't do comparables. You got these investors who are getting serious and they can't do research. Okay. Around these two sectors, innovative housing and commercial real estate, I think, and the practitioners don't have a place to learn who else has done it. So anyway, that's something I'm interested in. We create gatherings. I'd love to create something, on the side, maybe even, but at least by September, maybe we let's gather folks in September working on this. Okay. Sorry, this you got a pitch from me about neighborhood economics, September, Asheville. Okay.
So Jim, let me throw another idea at you.
Yes.
Which is in Michigan, some colleagues there have been working on a state piece of legislation that up to this point really has enjoyed bipartisan support. So there's really no question in my mind that it's going to be passed, but it's a 50% tax credit for local investors. And you could put a little screen on that and say, well, we really want to emphasize affordable housing or commercial development in low-income areas. But I feel like Georgia was one of the first states to pass a crowdfunding law when it was clear that the federal government was going to drag its heels for a few years. And I feel like there is a critical mass of interest in state politicians around this. And again, enjoying real bipartisan support. But, you start getting a tax credit in, and maybe you can move down to a 3% rate of return, and they're effectively getting 6%.
Right.
That's one of the things I love about having Michael on the show. It's like, oh, I never would have thought of that. I think about market interventions, and he thinks about the policy innovations that would help the local. That's one of the things I hope to learn more from him doing these shows.
Well, and the truth is, Michael, so I think everybody that knows the low income housing tax credit world, we would say if you look at that over the length of time, how many years now?
Oh boy, we're getting on 50, is it?
Yeah, like it's coming up, and like what it has produced and the amount of local investment that it's brought into housing is successful by so many measures.
Absolutely.
And at the same time, if you talk to developers that do LIHTC projects, they will tell you it's just getting too hard. Like the margins are squeezed on both ends. And so I do think we need innovative thinking about it again. Like it's time, like we shouldn't 86 that program. It's too successful. At the same time, we shouldn't assume what worked 25, 30 years ago is going to work in this environment. And like you're talking, Michael, making some concerted changes, trusting that we actually can do this in a way that allows us to continue to produce deeply affordable housing, which I would tell you the LIHTC project, it is having trouble reaching on the lower end.
Right.
Also, I would tell you
Yeah.
that we haven't figured out LIHTC for home ownership, which
Right.
Mm.
once again I would bring that in, that I think we could, but I um, Georgia, I would say, is conservative on that. They've been generous. Like, we've benefited from the LIHTC project, and we would do it again. Like, we have a project that we're doing, that we're building a restaurant with 18 units of housing, a 12-plex and a 6-plex. We're going to manage them. Ended up, it's too small for LIHTC. Doesn't quite work for new markets tax credits, and so we're doing it ourselves. But we literally got a financial gap in that took us 2.5 years to fill.
Hmm.
Like, we talked to bank after bank, investor after investor. They love FCS. They love because we're talking about our housing work, but we do some really neat neighborhood engagement. We have a coffee shop and a grocery store that we run, employing people from the neighborhood. We're building a restaurant. Like, they love FCS, but the numbers have to work
What
for a
do they
project to
need
be
to see on
successful.
your balance sheet that's not there now that would enhance their ability to extend more credit to you?
Well
Oh,
said.
that is a really good question. And you say,
I mean,
and
you
I
know,
got
it's
somebody
because
else in the room.
it's worthwhile, I think, engaging them in this conversation, um, and part of the reason is that, and at some point, Kevin, we probably should have talked to some community bankers about this and from their side of the equation. But my sense is that, community banks have been in enormous difficulty. They've experienced steadily rising regulatory burdens since Dodd-Frank, and so many of them have gone out of business, many have merged, but all of them are searching for a new purpose. And you really offer them an incredible purpose. So I feel like if we can make that more front and center.
Well, we did a lab. I mean, just to interject, with Purpose Built at Neighborhood Economics to help them think about themselves as a network of 26 places, as opposed to the deeply FCS focused word of Purpose Built, because there's a lot of Biden money that you have to tell a clear story for. And so I think this is just another increment of the narrative challenge of one Purpose Built, that we could look and see what other purpose builts need that other same narrative element to describe this capital gap. Like, where else is this capital gap across the 26 units of purpose built, and what stories are getting the banks in earlier? I mean, that's purpose built it's where a bunch of the Biden and Fed folks think this zip code focused money from Biden should go to it and its peers, right? So you got to make that money flow easy with a narrative, because they send not very senior MBA internee folks out to be the level of scan for the upper level folks. So we got to make the story of the money across the purpose built network, of which Jim is a great example, make sense to bigger money. So you pointed out a particular problem that is also a big problem.
I
And
would,
Purpose Built asked me to be involved in it. You should come to their conference in Birmingham. I'm going to spend a couple days with them too, Michael, because
yeah.
Great.
this is a thing that they want to think about.
Michael, to your question, I can tell you the way it took me a moment, but the way we solved balance sheet is with a local institutional uh, foundation. So
Yeah.
Right.
Yeah.
Somebody
they,
posting their balance sheet. Yeah.
it's like having your mom and dad co-sign for a loan.
Right.
They co-signed it. Um, they have to go through their own risk matrix and look at us. But one of the ways we solved the balance sheet problem is by using a different balance sheet, right?
Right. And
Right.
this hopefully can help solve a bunch of
Right. And
problems
so
at the
pooled and
foundation
shared
level.
loss reserves are a great thing across the network. I did it with, Optima and Mortar and some other folks. We tried to do a pooled and shared loss reserve for the leading accelerators. And they weren't big enough, at this scale, the thing about a pooled and shared loss reserve is that the money is somewhere in the network and it won't be called today. So, you get more money out on the street by having, your the history of your losses pooled, so you get more money out on the street earlier. Wow, this is so cool.
Mm.
Joel, are you back with us? I don't think he is. Joel is going to do an interview with you about how you became who you are in this space. And that's one of the things I just want to give him that airtime. It's a follow-up on Mindful Marketplace. And
Okay.
then since this is the second one, I'll talk about some of the structure of it. Michael and I do an interview. You were a fund investing in disinvested neighborhood. That's going to be my focus. Michael will look at how you can do things locally, like the Michigan stuff, all that kind of stuff. And
Yes.
it's a great pairing. And I don't think about policy, and he does. So
Yeah.
that's a good addition. And then these will be, we got somebody to curate them, and they're in a database at Impact Alpha, and that is the local economy database. And so there'll be a place to be searchable, and they do a promotion, and they have really great reach. And then Michael has his 8,000 plus with Main Street Journal, and we have our somewhat geekier economic justice focused 2,500 and growing newsletter. So those three outlets for this thing.
Mhm.
But then we're also and we're getting another person who's interested, who won't look like another white guy, to be here, and maybe two people. I've asked two people I work with who are investors of color who
Nice.
it could be great. And then and we want it to be a place where you can start, doing some comparables around the hot sectors. Your sector, the workforce development uh, sector, and the workforce housing sector. And specifically, affordable housing is its own thing. It's cumbersome, whatever. There are things down lower, but 50 to 80 LMI, is a real sweet spot, and nobody hates it.
Right.
So you don't have any NIMBY kind of thing if you want to keep a teacher at able. Last year's teacher in Buncombe County got interviewed for the award, and it said, "But I got to move away. It's taken me an hour and a half to go teach a job that doesn't pay."
Right.
So we are losing those people, as well as the gig working tourist industry folks. So I'm really focused on that, and I want to would be really good for the practitioners to start learning. So anyway,
For sure.
So I want to throw, since I've been identified as a policy geek, I
A walk.
mentioned the one policy thing that I discovered today that I'm really excited about. So investment crowdfunding operates off of a law passed in 2012 called the Jobs Act. There is currently pending on Capitol Hill revisions for the Job Act. It's got bipartisan support. It's called the Expanding Access to Capital Act. And one of the provisions in there would applies to micro funds
hmm.
of under $5 million. Currently, you cannot use crowdfunding to raise money for a micro fund, but this would allow it. And again, for someone like you, Jim, I think this then would open a huge set of new opportunities.
Yeah. Yeah. I love the idea. I just love the idea of bringing investment, you know, like, yes, to qualified investors continuing to do what they do well, but bringing investment down to the level where people can begin to build wealth. Uh, I, gosh, it's just so important to what we do. And
Yeah,
I love the idea of marrying that idea with the production of infrastructure within a neighborhood
Right.
that, Kevin, per your words, the owners are walking down the sidewalk past something they have part
Yeah.
ownership.
Yeah.
That's just such a great reality.
Harold Pettigrew, who's now head of the CDFI organization, used to say that, you know, a job gets you by and an asset gets you ahead. You know, and I think that's totally true.
Agreed.
This has been great, guys. I don't have any more to add, but I will follow up with Jeremiah to talk about, you know, some kind of peer gathering of workforce housing folks. We're doing a session at the ACT Local School, which I'll send you, and I'd love for you to beam in, or if you happen to want to drive up to Asheville. You know, I'm doing it
from where we are.
Yeah, we have a guest house.
I could be there. But,
yeah, we have a guest house, and it's Wednesday from 6 to 8. Well, I'll email you the dates. I don't want to lose anyway. But that'd be great. We have folks doing it. I'd love to have you. And again, you can use we have 2 Airbnbs on the farm, so one of them we'll make sure one of them's free. So it's a free place to stay. It's on the river.
Are you talking September, or are you talking something else?
No, this is a class I'm doing with my daughter called the ACT Local School, and we're doing a workforce housing session. And it starts March 20th, and it goes for 11 weeks. And gotcha. I would love to have you come up. We'll have some local folks who are doing workforce housing, and the activists who are trying to get the Tourism Development Authority that brings in $40 million a year to do some affordable housing for tourist industry folks. And right now, they don't see that it's their job, but people are suggesting that it is their job. They're an unregulated, crazy tax, and nobody. They're ungoverned anyway, and they're growing at $10 million a year in revenues, based on occupancy tax. That's kind of crazy. So yes, I will but then let's get people working on this. And Michael, I'd love to have you in the mix if you want to be in this thing.
Well, definitely, yeah. Send me information about it.
Okay.
Sounds interesting, and I love the idea that's come up a couple of times in this conversation of just creating a school around this. Because you said, Jim, you're not a financial expert. Honestly, none of us are, because this is a field of finance that is new even for well-heeled practitioners.
Right.
So we do have to kind of educate each other.
We haven't thought about how the benefits should go to folks who didn't used to need help. You know, I mean, that's the thing. Teachers used to be able to pay for a house. Now they can't. So you got to do something
else out. Yeah.
And you obviously have to be concerned about people, you know, having ownership and assets. But I think the workforce housing thing is a thing that, you know, you can start people thinking about it by getting, you know, teachers and cops, you know, focus 80% on my teachers and cops, and then you can spread from there into the disinvested neighborhoods who also need assets. But it's an easier entry point, you know. I mean, you know, you're dealing with fragile white environmentalists, you know, with a lot of this stuff, and so you don't want to scare them right away. You know, you want them to invest collectively.
Some truth to that. I wouldn't say he's a fragile white environmentalist, but I had a friend that we were trying to borrow $750,000 on a project we were working on, and he's a commercial investor, like a commercial builder, and was working to help do a fund, an affordable housing fund here in Atlanta. And I was sitting with him and talking about this is how we acquire the houses, how we rotate. Here's our average costs. Here's like going through the whole thing. And they were willing to do the loan, but it was 6%. And this is 4 years ago. And I was like, it's just too high. And he's a commercial investor, so he's used to getting 8. And and I'm like, it's just too high. And I said, does this program, which we've been doing at this point, we've been doing this for 10 years, we've not money. We've enlarged our corpus. Like, does this feel risky to you? And he sat back and looked at me and he goes, hell yes, this feels risky to me. And I was just like, that's our problem. Like, not like,
Mm-hmm.
how do I get you to look at what we've done and believe that we can turn this money over and pay your percentage consistently and safely? Like, we've been doing it now for 10 years. Now we're at 15, but it's really hard because investors just have a natural,
Right.
the what I want to say, the dials that we look at
Right.
that tell us risk are not necessarily working right. And I understand why they are like, I just don't know where to put this. I
Right.
have a bank that I was talking to, black owned bank, wants to do mortgages in our neighborhood, was like, we would love to do mortgages for families you're working with. And so I was like, tell me about it. And they described this amazing product. It's a great product. It's uh, um, zero down payment, comes with assistance at the get go, um, uh, cash assistance that they can buy down points. Like, it was this great program. And I said, okay, my first question is, what's the credit score that somebody needs to have to get
Ah,
that? And they said, uh, 620. And I said, well, here's what you have. You have an amazing vision to serve my neighborhood, and you have an amazing product, but you don't have a match yet.
right.
As long as 620 is your first hurdle for risk, that, like, I could give you a
Right.
family and it will never pass your loan
Right.
review.
Diamond Hargis created the Neighborhood Vitality Index to combat that. And if you know what he did, he got a
Yeah.
bank to lower the cost of mortgage refinance by showing the social capital in a neighborhood and
Yeah.
showing that it was resilient and not risky. You have to make the social capital and the misperception of risk line up. They
Yeah.
have to see the value in people they're not used to seeing value in.
Which is, for me, Kevin, I would say that is when we are talking to, we're talking about a changing industry. And so when, Michael, you say there's actually nobody who has this solved yet. So even the experts are struggling to figure out how to solve it. And if we're going to ask them to change, we need to bring that into the conversation. So
Right. Well,
the risk matrix,
misperception of risk is why unarmed black men get shot. I mean, misperception of risk is not just a trivial thing when you're trying to do a deal. It's also your likelihood of dying is higher. I mean, it's a broad problem that is showing up here. So that's a thing to be helping to change.
yeah,
Well, that's what I love about what we're hearing with Jim and these other funds we're bringing on is that it's really about redefining what risk and reward means, what value means for for our entire communities. And so I know we're coming up on an hour here. I absolutely you guys didn't get to see me as much, but I was listening in, so I got to hear most of what was going on here today. But yeah, Jim, so thankful for where can people find more about you or how to get involved with your fund?
thank you very much. So you can hit our website. I'm assuming that'll be in show notes.
Yep.
Uh,
Yep.
fcsministries.org. You can hit my LinkedIn, just Jim Wayner, and you can find me connected to FCS.
And we're
Yes.
looking for more funds. Send funds our way. We want to build a database that is really the local investing, and then we want to make sense of it. Look how Jim solved this part of it. Look how Steve wanted to solve that part of it.
Exactly.
Because everybody's solving with slightly different tools. I mean, there is a lot of mashup possible. When I think about this space, I think of like most people probably. I think of the broad highways of Havana. And where those old, cars from the 50s would meet in the center and they would trade parts. And they would also have newly forged parts that worked with the 56 Chevy. I mean, I think, we need to swap the innovations of the folks who were making it work.
Yeah, I love it.
Yeah, I think so too. Great.
Well, I think
Michael,
we
you want to take
always
us out?
Yeah, we've lost our host again, but we
I
haven't
know.
lost our mojo. So, Jim, thank you very much for spending time with us. We really appreciate it. And those of you who are listening, stay tuned for Mindful Marketplace because we have a bunch of other wonderful funds and practitioners that we're going to bring your way in the coming months.
Okay. Thank you so much. We're just starting to work on this show. Our host was absent for most of both shows. I'm not sure what the deal is, whether the software doesn't like him or the bandwidth doesn't like him or who knows what. But there are three of us. So,
Well,
okay.
I'm
This
Let's see.
grateful
this,
for the
this,
opportunity. Thanks for the invite and for the conversation. I love the
Right.
conversation.
And
So,
send more folks our way. We want to help people make sense of this space, and help investors decide to be in the deal. We want to lower the risk, right? I mean, if we make some analytics around the stuff you're working on, then it lowers the risk. We got to get somebody to fund some white papers and research, and get a school engaged. Roosevelt University does a lot of stuff. Anyway, we should we should think about that.
yeah, for sure.
We need people who can talk to academics better than I can to explain what we need. Probably we have some people who went to school and got degrees and that kind of thing.
Right.
Okay, thanks a lot.
Awesome. Well, thanks
right.
everyone for tuning in, and everyone have a good one. As we say out on the Mindful Marketplace, remember, we are each other. So until next time, take care of yourselves.
Bye-bye.
Thank you.
Bye now.